Hey, good morning, everybody. It's Hammer. Today is Friday, January 9th, 2026. What a way to start off a new year. Let's go ahead and just turn everything on its head. So, anyway, today is going to be a fun day. I'm sure we're going to have lots of people on this morning. If you are here live, be sure to say good morning in the comments. We got John Vachito in this morning. Amy Blauser, good morning. Amy Blauser, is that Zane too? Is that my man Zane? Tom Deadmore, good morning. Charlie Badita, great to have you here, my friend. Rob Smith, Nicole Semerad. Look at Adam Check getting up early in the morning. What's up, Adam Check? Dude, snow. I'm loving it. Stephanie Hale, Bill Stevens, good morning. Robin Willard and Mike Tebow, great to have you all here. For those of you, I'm sure you all know me. I am Hammer. I am the founder, though, which you might not know, of 3 different products. So my company is Hammer Solutions. I don't usually market that. What we do is talk about the different products that can get you business, originator success, grab and go social, and Rate Sensei. Now, this rate conversation falls under the Rate Sensei umbrella. So anyway, you can learn more about those on their websites and all that good stuff. Remember, you're probably here this morning because of all the activity, but you can join me live each and every weekday morning, 9:30 a.m. Eastern time, broadcast on Facebook and on YouTube. If you'd like to make this a consistent part of your day, make it a habit, you can get a reminder, hmmr.io/reminder, or you can use this cool QR code over here. And we send out a text alert that we are going live so that you don't miss the show live. So, and of course, you can unsubscribe at any time. You just, it's not a big deal. But, and we don't sell your name or do anything hardcore. It's just to let you know that we're here and live. So, Ken Peterson, Booker Pruitt, good morning. Robin Davis. What's up, Mr. Ron Siegel, one of our OGs? We got Ron Siegel. He says today is National Law Enforcement Appreciation Day. We won't go too deep, but just remember something. When you need them, you appreciate them. So, and for those of us that have family and friends in law enforcement, it is a tough gig. Not every cop is a good cop, but there are a lot more good cops than bad cops. So I will absolutely say hats off to him. So Randy Tico, good morning, sir. So yeah, let's go ahead and get started. We're going to jump in. We have so much to cover today. So basically, there's 2 things we're going to really dive deep on. Number 1, we're going to go into Trump's Truth Social post from yesterday, where he talked about what was going on with the wanting to spend, I don't know why this program's not going away. There we go. I'll just move it out. Wanting to spend $200 billion on buying mortgage bonds, and the reaction to that this morning. Of course, that's one of the big things that's fueling everything. And then we'll talk about the jobs data this morning, which actually was not really, it was kind of, there was things on both sides that made it good or bad for bonds, but the reaction that we're seeing. And most importantly, we're going to talk about the reality of where rates are and where rates are going. And I want to hear from you guys. So I know we're going to have, look at that. We've got almost 100, we'll break 100 people today, which will be fantastic. It'd be great to see all of you here. So let's dive into the actual technicals first. We'll start out here with the actual, let's take a look at mortgage-backed securities and kind of where we're at. And we'll talk about how we got here. So we're going to try to keep this clean and focused, so I don't run around too much. So right now, the 5.0 coupon, which is the mortgage-backed security that we've been watching, currently up 14 basis points. Now, that may seem to be a striking number when you may have seen that just an hour ago it was up 70 basis points, right? And that's what we see right here. This is the 48-hour chart. Now, to give credit where credit is due, especially with a full house, I'm showing you everything on MBS Live. Anybody that wants to, monitor all these things in real time and all that stuff, you absolutely, this is a great service. MBS Highway, also a great service. These are great services. I'm not saying a thing about them. We're going to focus, though, and use MBS's live screens to show you what's here. However, one thing I do want to remind you is if you want to, see what's going on, you don't have to spend a lot of money to have these services. If it's not really your world to have these services, if you don't want to look at at all these charts and everything, you can go ahead and sign up for our text alert service. It's down at the bottom, www.ratetextalerts.com. They're $7 a month. And this is an example of, like what, oops, let me pull that back up. Hold on. Went behind, hid behind here. This is an example of, why you want to have something is at 4:34, I sent out this text talking about locking ahead of the jobs data. And then a few minutes later, I had to send out this text. We went from -8 basis points yesterday to up 29 basis points. And that was when that happened. That occurred when we had a jump in mortgage bonds because of right here. You can see it right here. So mortgage bonds yesterday were flat on the day. They really did not move. Everything in front of this dotted line right here to the left of this is yesterday. Okay. So everything in yellow here is yesterday. And then you can see we saw a jump and another jump. And we ended the day tremendously higher. Now, how many of you got reprices yesterday when that happened? I'm curious. How many of you, according to Mortgage News Daily and MBS Live, there were only a handful. Most lenders were not ready to act on that. So some of the wholesale lenders I know did jump in, and I think UWM, improved pricing by about 30 basis points. But just to be clear here, we didn't see rates drop through the floor. We just saw a jump in mortgage-backed securities. It was a big swing. It was about 35 basis points. So there was a big swing yesterday. And again, that was caused originally by this Truth Social post from Donald Trump. I don't want to get into the part again. It's funny whenever we talk about this stuff, someone's going to say, well, it's politics. It has to be politics because it involves politicians, but we're not arguing who's doing it, why they're doing it, or that part yet. Let's just talk about what happened and where it's going, right? So he said, because I chose not to sell Fannie Mae and Freddie Mac in my first term, a truly great decision and against the advice of experts, it's now worth many times that amount. And has 200. This is the important part right here. It has $200 billion in cash. Because of this, I am instructing my representatives to buy $200 billion in mortgage bonds, and this will drive mortgage rates down. Now, what this smacks of is quantitative easing. Quantitative easing is normally when the Fed buys treasuries and mortgage-backed securities to drive rates down. It's what the Fed did during the pandemic, along with lowering the Fed funds rate to 0%, and the government putting in fiscal stimulus, right? So that's what drove rates down to those really, huge levels. Now, $200 billion, it's a lot of money. I mean, I certainly wouldn't shake a stick at it, but the mortgage market is trillions of dollars. And I forget what trillion, I could look on there, but it's trillions. This absolutely will have an effect depending on how it's done, when it's done, and how long the effect will last is a question. Now, this is the important part, is he said, I chose Fannie and Freddie Mac and we're going to use their money. It's not the Fed. Trump cannot tell the Fed to buy things. And the Fed doesn't listen to Trump. That's partly why Trump has gotten so aggravated about everything going on with the Fed. So that's not the thing. And I saw like 10 posts yesterday on Facebook when this was first coming out on CNBC, and they didn't really put anything in there. And people thought that he was telling the Fed. He's not telling the Fed. The Fed is not the one doing it. Now, so on the news, but again, look at where we're at now. We're only up 11 basis points this morning. On that news this morning, everything continued to skyrocket. Look at this. Oh, you can't see it. Hold on. Let me get my screen out of the way here. Let me move this over. Okay. So then we ended the day yesterday up quite a bit. That's going to give you better pricing. This will take us to basically those levels that we saw. Let me pull up in purple here. These were the levels that we saw in the past before the Fed meeting that gave us that best pricing, brought us up in that same range, would bring us to the low sixes, probably improve rates. When you move 40 basis points, you're improving by 0.125. So that is kind of, we are absolutely going to see better rates today, probably an eighth of a point. Very aggressive lenders, it could be closer to the quarter, but most lenders are going to be about an eighth of a point. Has anyone priced anything that you can back me up on this? And yeah, I mean, that's Ron. I don't get it either, and you're a lot smarter than I am. So we'll on that. So what I want to show you though is take a look here. What's important to note: what has not moved is the 10-year Treasury yield. Normally, when something occurs that influences mortgage rates, it also influences that 10-year Treasury yield, and we would see that yield drop. This has not dropped. So what we're seeing is specific manipulation and trading in mortgage-backed securities, which are, let me make this a little smaller so that we can share it on the screen here. All right. So which are right over here. We're seeing it's all in the MBS world. Now, this morning, bonds went absolutely insane, and around 820 is when you get domestic markets open. Okay, so at 820, mortgage-backed securities were at 100. Boom, 100.67, and they were trading on speculation. But look what's happened since then: down, 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 down. So right about here this morning at 8:30, we were thinking, holy smokes, rate sheets are going to come out. Rates will be down in the fives. But that's not what happened. And it's not what's going to happen. We're already down. Now look at this. We're up 3 basis points on the day from yesterday. We are basically back flat to where we were right here. Let me move this over so that you guys get the whole thing. Okay. So it's important that we don't overreact to this. And different lenders are going to react differently to the news as well. Remember something. One of the things that happens in a scenario like this, we start talking about float downs and lock fallout. All right. My son is closing on a house today. We did an internal family mortgage, but let's pretend that he was getting a mortgage from a lender. Let's pretend that he got a rate of 6.5, and we see a huge drop in rates. What's going to happen if he's trying to close today? He's going to have to close. What happens in a month? He EPOs because he's going to refinance immediately to a lower rate if it's a significantly lower rate. Okay. There's no time, so that's somebody that's that close. Somebody that's got a little more time. You've got some float down policies that can help, but lenders are still taking it on the chin on float down policies because they've already committed that loan to be sold to an investor at its locked rate. 155 people on. That's fantastic today. Welcome to all the new faces. I hope you'll join me on a more regular basis. So I'm going to keep this short. We're only about another 7 minutes. I run about 20 minutes a day, but just wanted to explain all this. So here's the thing that we need to focus on. Where are things going from here? So we talked about what drove it here yesterday. The whole Trump tweet, the reaction to it. But take a look this morning at what we've got going on here. Let's talk about the jobs data and where that actually came in and what that actually looks like. So when we get to the jobs data, job gains cooled in December, capping a year of weak hiring. This is important. Unemployment was 4.56 last time. So it went to 4.6 because they round it. So now it fell to 4.4. Markets were expecting that it would fall to 4.5 because of the way that rounding worked. They knew that 4.6 was kind of 4.56 is not 4.9. It's, or I'm sorry, 4.5, whatever. So it rounded up to that 4.6, but they were expecting, okay, it may go to 4.5. It fell to 4.4. There were less jobs created than expected, 50,000 jobs in December. They were expected to see 60,000. Actually, according to Wall Street Journal, they're using a number of 73,000 is what they were looking for, according to what they're using here. But I saw a lot that were around 60. It was weaker than the revised 56,000 jobs added in December. Now, I remember reading that the participation rate was down a little bit, meaning the number of people that were out looking for jobs. So that would also come into play a little bit here. But all of this in here, we're seeing a slowdown. This really sums it up well. we're seeing a slowdown in job gains and unemployment has been choppy. And employment has been choppy, but the labor market isn't falling off a cliff. Now, putting aside the idea that we could see this quasi quantitative easing, buying $200 billion in mortgage backed securities, if that was not on the table, what would this report have done? We probably would have lost ground, which is why I had been in a locking stance yesterday before Trump's Truth Social post shook everything up. This is not really all that advantageous. When we take a look at the effect it's expected to have on Fed futures, markets pricing in even less of a chance for a January Fed rate cut. Now, again, this is a complex topic on how this is going to drive mortgage rates. There's a lot of hype in our world. But when you look at the main headlines on Bloomberg and you look at the main headlines on Wall Street Journal, this whole Fannie Mae, Freddie Mac buy $200 billion worth of bonds, drive mortgage rates down, it's not even close to a front page news event. It's a big deal to us, but it's not a big deal. It's not, and it's, and we don't know when. This is like that 50-year mortgage post. It's like that we're going to ban investors from buying. There's a lot of noise. And I know some of you are big Trump supporters, and get over it. Okay. This is not an attack on Trump. I'm not a Biden fan. I'm not an anti-Trump fan, but you have to be realistic. They're blasting stuff out there. It's all smoke. It's all smoke. There's no substance to any of this. There's no reality to any of this. Now, it is a novel approach that you could argue that Fannie Mae and Freddie Mac have room on their balance sheets to buy mortgage-backed securities. But then when you start, and I am not a stock guy and I am not a corporate guy, but the way that I understand it, they also have certain requirements for having liquidity and reserves that this would totally annihilate. And basically it would overextend them. So I don't know the details, but be careful what you're posting and how you're posting. All right. And I don't want to make this a social media thing, but just definitely there. So the other thing that's a big thing today is that the SCOTUS, the Supreme Court, could come out with the ruling for the tariffs. And there's an argument that that's why this was done as, another distraction. Again, I don't want to get into the he said, she said politics and throwing mud. These are just all things coming into play. The jobs data itself, not really all that weak. Yes, there is weakness in the labor market, but this wasn't we didn't see unemployment get worse. It got better. We didn't see a negative jobs number. We saw 50,000 jobs created. So this is not the kind of labor market falling apart that would require the Fed to take immediate or emergency action. Nothing here. Next week, we're going to get CPI inflation data that comes out on Tuesday. It's not likely to be amazingly better or amazingly worse. It's not likely we see a lot of movement on this. So right now, you want to be ready to lock in our whopping 1 basis point gain here today, right? But we did see, and I'm going to go back full screen so I can bring this up there. Here. So Marshall said, all right, let's bring some of you guys in your comments in on this as well. And we'll go over that. So let me see. All right. So Marshall said, yeah, but who sets the requirement for reserves for Fannie and Freddie that could be easily changed and allow them to dump into the MBS market? So they could buy in, but how long are they going to hold it for? What is it? I don't know the answers to these questions. It's not my area of expertise. You know what I'm good at? I'm good at getting people to write loans. I'm good at getting loans. I'm good at knowing where mortgage rates are headed. I am not an economist and I am not a market guru. I am not a stock guy. I don't know shit about corporations except for that I have an S Corp election on my LLC when I do my taxes. So I'm not going to pretend like I have big boy britches on and I know more than I do. But this is a great question. And this is the thing is that's why they throw something out there and it hits in a post, but it's like, okay, well, what's the reality? What are we really going to see? And this is what happens when the dust starts to settle, y'all, is that we see a lot of, sell the sizzle, buy the hype kind of thing. And, but then look, I mean, we have gone from a peak of 100.67 down to 100.13. That's 60 basis points, 64 basis points that we were up here and we fell to down here just like that over the course of an hour. So it's there, and markets are flat right now. Now they're still up on the day. And again, take a look. We are yesterday, yesterday did put us up quite a bit on the day, and it brings us up to 99.90 was like kind of a previous, kind of a resistance point, and it blew us through that to 100.11. I have a feeling we're going to fall back down. So you want to be, I mean, an hour ago, we would have been in a pure floating stance doing the happy floating dance thing, right? But when you see this, what does that point out to us? Points out to us that this is not gonna last. What we're seeing is speculation trading to what's going on and the rumor and the post and all of that. But it's like a fart in the wind. It's like a fart in the wind, y'all. This is a challenge for loan officers today, advising on indications and smoke and noise, and the market can move on you. Absolutely. This is one of those times that, like based on seeing this huge drop that we've seen this morning, if you've got a really good rate sheet, again, it's going to come in post here. So we can trust it for a little while. But if we see this continue to move negative, you're going to want to look to lock. What we're really locking in is yesterday's gains. We went from 99.72 up to 100.13. That's 40 basis points. All right. You're basically seeing a 40 basis point improvement on rate sheets. If we use Mortgage News Daily as a reference point, that means you would have gone from 6.21. How many of you, again, I'll look back, but how many of you would have gotten how many of you would have gotten a reprice better yesterday, and how much better was it? There were not a lot of them. So, and thank you, Ken. Yeah, that's what can I tell you, man? So, we're going to see 6.21, probably brings us down to like 6.6 and an eighth, right? Let's call it 6.13, which was, if you remember, that was the best rate sheets that we had right before the last Fed meeting. So I've always told you, be ready for these windows, but this is not going to drive rates down. The idea of buying 200 billion, to put it in perspective, the Fed was buying like crazy numbers at the beginning of COVID in March. Then they went down to buying 40 billion a month after month after month after month after month to drive mortgage rates down and keep them down. When they stop buying, what happens to mortgage rates? They go up, right? Quantitative easing is much more effective, much more of an effect on mortgage rates than just Fed cutting rates. So this idea, if they want to blast the market and buy 200 billion, we're going to get a dip in mortgage rates that looks really good on paper for a while. But what's going to happen? It's going to go right back up because it's not sustained. There's nothing to sustain that. So how are they going to spend 200 billion? What are they going to do with it? For how long? What's the real end game here? The only way that you're going to drive mortgage rates lower and they'll stay lower is if it fits into the entire market equilibrium and it makes sense. Now, let me ask you this, right? Why would you pay a ridiculous amount of money for a mortgage-backed security when you could get a 10-year treasury at a better price? Okay, remember that too. That's why mortgage-backed securities and the 10-year for true investors, not a manipulated market, but for true investors, if you're going to spend $100.50 on mortgage-backed securities or $100.50 on 10-year treasury, 10-year treasury has no repayment risk and it's backed by the U.S. government. There's arguably no risk. Why, if the yield is higher on mortgage bonds, why is that? Are they going to buy mortgage? I'm sorry, on the 10-year treasury, why would you not buy that over the mortgage bond? See, none of this makes sense to me. Joe said this is the beginning of a larger trend. What larger trend though? What larger trend? And yeah, I mean, that's what we'll take a screenshot of that one, Adam Scheck. That's my take on this whole Trump post. It really is. This whole thing is a fart in the wind. It's a big thing, like the 50-year mortgage, the assumable, mortgage, and the mortgage that they can bounce around. It's the same thing as institutional investors. These things make it so everyone's going to run to Facebook and post about this crap, but it's not doing anything. Like I said, this is not even remotely making it to. If we look at the Wall Street Journal, the top thing is not Trump going to buy mortgage-backed securities. The top thing is the jobs data, which is really, payrolls rose by 50,000, jobless rates fell by 4.5%. It's not really a big thing. Stephanie, I bet we fall, so going to lock as soon as I can today. Reaction days are usually the great days are to lock or terrible, and then Monday the markets have amnesia and everything's back to normal. Stephanie, I absolutely agree. I would be looking at locking up a lot of those gains today. I don't think there's a lot of a downside to that. Right now, mortgage bonds are up a few basis points, so you're talking about some really great rate sheets. This is one of those windows. This is an opportunity today to reach out to people that fell off the refinance wagon, but I would not once this an immediate reaction to the Trump post. I want to call it a tweet, but it's not really a tweet. Once the reaction to this is over, when are we actually going to see it happen, and what effect do we really see over time? It's not going to be tomorrow. It's not going to be next week. So I think that I agree with that. I think that we kind of see things stay here. I think we're going to lose some ground. Bill Stevens, he says probably a small window opportunity to get in front of your database and fish for some cash out refis. Yep, absolutely. Jerry, true statements, 100%. It's all hype for a month. Yeah, I mean, and I don't think it's for a month. I think it's for a couple of days. Mortgage Mike in Florida there is going to flock. That's a flocking good idea. So the markets always overreact. Ron Siegel, the man of the people, absolutely, positively, 100% correct on this one. Markets always overreact. With that in mind, if they're overreacting, that's why you want to take advantage of what's on here. I absolutely agree. What do we think going forward? If there's time, lock today or float. My pricing looks pretty much the same as yesterday. That's got to tell you something. So again, look at what is happening in, say, Kay's situation, right? By the way, if y'all want to join me, I'm going to wrap it up soon because I grew long. I'm in for a half an hour now. You can go ahead and sign up for a reminder. This is a free text. Sign up for these. It's free. If you'd like to start, getting on the lives as part of your morning routine, you can get a reminder for those or use this cool QR code over here. Anybody that wants to sign up for our rate alert texts down at the bottom, www.ratetextalerts.com. But to answer the question from Kay, let's go back to Kay's question. Yeah, if your pricing looks the same today, well, then that's a problem, right? Because that means that your lender is not pricing in a move of about 40 basis points. So let me just take Kay's question off the screen for a minute so we can see this. I would not be in a hurry to lock anything that hasn't moved from here. Because remember, if you're pricing when mortgage-backed securities, the 5.0 coupon, when that was down to 99.73, and right now we're at 100.27, that's 50 basis points higher. That should be a significant pricing difference. If you're not seeing that for some reason, I wouldn't be in a hurry to lock because we are still up 50 basis points from yesterday. And again, yesterday it was, pricing was the same all day. It was flat. Look how boring that was. And then boom, big jump. And then today volatility. But even with that volatility, we're still up. Now, we were down to zero a little while ago, and I told you we're going to have volatility today. Look at this. Pricing's coming out about now. We're up 14 basis points on the day. You should see better rate sheets. The question is, if you see those better rate sheets, should you lock them? Sign up for our text alerts, cautiously float to start, and let's see what happens. Do we continue to see bonds rally a little bit? Or if not, and we're seeing it kind of cap out today, I would lock some loans. Why not? Because we don't know what Monday's going to bring. We don't know where the speculation is going to continue. And you know what happens. It's very easy to lose a loan because you've lost a little bit in pricing. So if it's a refi, take it and make it. So Vicky, thank you. Ken, thank you. So, all right, y'all. Well, Ben said, meet Kevin. I like meet Kevin too. Had a good video about this yesterday. Seems to think rates will come down in the next 2 to 4 weeks, only temporarily instigating a mini refi boom. It's possible. He's a bright guy, bright young guy. So I do like meet Kevin. We'll have to see. We'll have to see. It's, but it is all on this. It bothers me that we're not seeing the 10-year treasury yield drop. You basically have a reverse spread situation between MBS and the 10-year. And this is not this is a problem. This is a problem. Mortgage-backed securities will only improve. They're not tethered to the 10-year, but yet they kind of are, right? So Jessica, hello. All right, my friends, today, well, I hope you all have a fantastic day. I'm going to wrap it up. Thank you for joining me. Hope that helped. I'll look through some of the comments later, but anyway, go out there and drum up some business today with this and make the most of it. But just be aware, it could disappear very quickly. We have to actually see a plan for how they're going to buy 200 billion over what time frame, how much for how long, and how are they going to do it, and how long are they going to hold on to them? Because just like the Fed bought up all those mortgage-backed securities and then spent 2 years selling them back. So what are they going to do? Sit on those bonds and then just hold them forever and their balance sheet? And how can they do that? I don't know. I'll be doing some research on it. I'll be listening. I'll share my stuff that I find. But again, in the meantime, it's not a dig on anybody, but there's a lot of smoke and not a lot of substance yet. Don't get drawn in. Don't get sucked in. So, all right, my friends, have a fantastic one. Have a great weekend, and I will see you on Monday, and we can see where things go from then. I hope many of you that are joining me for the first time will join me on Monday. Take care, everybody. Bye-bye.